Look, I need to show you something that's been deliberately kept out of mainstream financial media. And when you see this number, you're going to understand why certain institutions have been so quiet about it. We're talking about silver, not gold, silver. And there's a supply situation developing right now that makes the nickel squeeze of 2022 look like a practice run. Let me start with what happened last Tuesday. The Silver Institute released their annual supply-demand report, and buried on page 47 was a number that should have made headlines everywhere. Total above-ground silver inventories available for investment and industrial use? 1.74 billion ounces. Now, you might think that sounds like a lot. But here's what they're not telling you in that same report. Annual industrial demand alone is now 609 million ounces. Solar panel production is consuming 161 million ounces per year and growing at 23% annually. Electric vehicles need 25 to 50 grams of silver per car, and we're producing 14 million EVs this year. 5G infrastructure requires 3 times more silver than 4G, and every single ounce used industrially is gone forever. It's not coming back. It's in a solar panel on a roof in Germany, or a circuit board in a data center in Virginia. But that's just industrial demand. Investment demand added another 237 million ounces last year. Central banks, who everyone thinks only buy gold, quietly accumulated 47 million ounces of silver in 2024. That's a 340% increase from 2023, and nobody's talking about it. So let's do the math that the Silver Institute hopes you won't do. Total demand, 846 million ounces. Total new mine supply, 822 million ounces. We're already running a deficit of 24 million ounces annually, and that's before we talk about what's really happening with above-ground inventories. Remember that 1.74 billion ounce number? Here's the part they buried even deeper in the report. Of that total, only 826 million ounces is in identifiable bullion form. The rest is in jewelry, silverware, and industrial stockpiles that aren't available for sale at any reasonable price. And of that 826 million in bullion, 417 million ounces is held by ETFs with strict redemption rules. Another 189 million is in allocated storage for wealthy families who aren't selling. That leaves roughly 220 million ounces of truly available silver in the entire world. At current demand rates, that's less than 3 months of global consumption. 3 months. Let me put this in perspective. In 1980, when silver hit $50 an ounce, there were an estimated 3.5 billion ounces of above-ground investment silver. Today, with a global economy 7 times larger, with technologies that didn't exist in 1980 consuming silver at unprecedented rates, we have less than a quarter of that available supply. The gold-to-silver ratio right now is sitting at 88 to 1. Gold is trading around $2,650, silver around $30. Historically, that ratio has averaged 60 to 1 over the past century. In Roman times, it was 12 to 1, which actually reflected the natural occurrence ratio in the Earth's crust. Even if we just revert to the modern historical average of 60 to 1, silver should be at $44 an ounce right now. That's a 47% gain from current levels just to reach historical norms. But here's why I think we're going much higher than that. And this is where the story gets really interesting. There's a man named Ted Butler who's been analyzing the silver market for 35 years. He's the one who first exposed the concentrated short position on the COMEX back in 2008. For years, he documented how a handful of banks, led by JP Morgan, were manipulating silver prices through massive short positions. The CFTC investigated, fined some banks, but the manipulation continued. Then something changed. In 2011, JP Morgan's short position started shrinking. By 2020, it had completely reversed. Butler obtained data showing that JP Morgan had accumulated somewhere between 600 million and 1 billion ounces of physical silver between 2011 and 2020. They were shorting paper silver on the COMEX while simultaneously buying every physical ounce they could find. Think about that. The same bank that was suppressing the price was using that suppressed price to accumulate the largest private silver hoard in history. And they did it so quietly that most people still don't know what happened. Now, why would JP Morgan do this? Why would any institution spend 9 years accumulating a position in an asset that most financial advisors say is just an industrial metal with no monetary value? Because they saw this supply crisis coming. They read the same geological surveys showing that silver ore grades have declined 35% since 2005. They knew that most silver comes as a byproduct of copper, lead, and zinc mining, and that primary silver mines are becoming economically unviable at current prices. They understood that recycling rates, despite being economically attractive, have plateaued at around 15% because silver is used in such small quantities in electronics that it's not worth recovering. And most importantly, they recognized that industrial demand was about to explode. This was before the solar boom, before EVs went mainstream, before 5G, before AI data centers started consuming massive amounts of power and requiring unprecedented amounts of electrical infrastructure. Let me tell you about what's happening in the solar industry right now, because this is the demand driver that changes everything. In 2010, solar panels used about 50 million ounces of silver annually. By 2020, that had grown to 110 million ounces. Last year, 161 million ounces. This year, projections are for 185 million ounces. But here's the kicker. The International Energy Agency's net zero by 2050 scenario requires solar capacity to grow from 1,200 gigawatts today to 14,000 gigawatts by 2050. If we maintain current silver intensity per panel, that's going to require 400 to 500 million ounces of silver per year, just for solar. That's more than half of total current mine production, just for one application. Now, the solar industry knows this is a problem. They're working on reducing silver content per panel. They've already cut it by 80% over the past decade through thinner wafers and better metallization techniques. But there's a physical limit to how much further they can go. Silver is used because it's the most conductive element on Earth. You can't replace it with copper or aluminum without significant efficiency losses. And in solar, efficiency is everything. I talked to a solar panel manufacturer in Germany last month. Off the record, he told me they're already seeing supply constraints. Lead times for silver paste, which is what they use to create the conductive pathways on solar cells, have gone from 2 weeks to 8 weeks. Prices for solar-grade silver are running a 12% premium over spot. And this is before we hit the real supply crunch. Then there's the EV story. A typical internal combustion engine car uses about 15 grams of silver. A hybrid uses 18 to 34 grams. A full battery electric vehicle uses 25 to 50 grams. And that's just the vehicle itself. The charging infrastructure requires even more. A level 3 fast charging station uses about 5 kilograms of silver in its power electronics and contactors. We produced 14 million EVs globally last year. That's roughly 420,000 kilograms of silver, or about 13.5 million ounces, just for the vehicles. Add in the charging infrastructure for another 3 million ounces. So we're at 16.5 million ounces for EVs in 2024. Now, the IEA projects 40 million EVs produced annually by 2030. That's 50 million ounces per year just for electric vehicles and their charging infrastructure. And by 2040, when most major economies have banned new internal combustion engine sales, we could be looking at 80 to 100 million ounces annually, just for transportation electrification. But wait, there's more. And this is the part that keeps me up at night. The AI boom is creating unprecedented demand for data centers. And data centers are massive consumers of silver. Every server, every switch, every power distribution unit, every backup power system uses silver. A typical hyperscale data center uses about 50,000 ounces of silver in its initial construction. And we're building these things at an unprecedented rate. Microsoft alone is planning to spend $80 billion on data centers this year. Google, Amazon, Meta, Oracle, they're all in a race to build AI infrastructure. We're talking about hundreds of new hyperscale data centers coming online in the next 5 years. That's potentially 10 to 15 million ounces of annual silver demand that didn't exist 3 years ago. And here's what makes this different from other industrial demand. Data centers have a 15 to 20-year lifespan. That silver is locked up for 2 decades. It's not getting recycled anytime soon. It's gone from the available supply for a generation. Now, you might be thinking, okay, demand is growing, but surely mine supply will increase to meet it, right? That's how markets work. Higher prices incentivize more production. Except, that's not what's happening. And this is the part of the story that should terrify anyone who understands supply chains. Global silver mine production peaked in 2016 at 900 million ounces. Last year, we produced 822 million ounces. That's a 9% decline over 8 years, despite silver prices being 50% higher than they were in 2016.
Why? Because silver is primarily a byproduct metal. About 70% of silver production comes from mines that are primarily producing copper, lead, zinc, or gold. Only 30% comes from primary silver mines. And those primary silver mines are struggling. The average ore grade for primary silver mines has fallen from 240 grams per ton in 2005 to 155 grams per ton today. That's a 35% decline in ore quality. It now takes more than twice as much rock to produce the same amount of silver. Energy costs have tripled. Labor costs have doubled. Environmental compliance costs have quadrupled. At $30 an ounce, most primary silver mines are barely profitable. Several major operations in Mexico and Peru have already announced they're transitioning to care and maintenance mode. They're not closing permanently, but they're not producing either. They're waiting for higher prices. But here's the catch-22. Because most silver comes as a byproduct, even if silver prices double, it won't significantly increase production. The copper mine in Chile doesn't care if silver is $30 or $60. They're mining for copper. The silver is just a bonus. And copper production is constrained by copper economics, not silver economics. So we have a situation where demand is growing at 8% annually, supply is declining at 1% annually, and the pricing mechanism is broken because most production isn't responsive to silver prices. This is the setup for a supply squeeze that could make the palladium crisis of 2000 look tame. Let me tell you that story, because the parallels are striking. In the late 1990s, palladium was trading around $200 an ounce. It was primarily used in catalytic converters for gasoline engines. Russia was the dominant supplier, producing about 70% of global supply from a handful of mines in Siberia. Then, two things happened simultaneously. Automotive production boomed, especially in Asia, and Russian production started declining due to depletion of their richest deposits. By 2000, the market was in severe deficit. Palladium prices went from $200 to $1,100 in less than 2 years. Auto manufacturers were paying any price to secure supply. Some factories shut down because they couldn't get enough palladium to make catalytic converters. Eventually, the crisis resolved through substitution. Engineers figured out how to use platinum instead of palladium in catalytic converters. But it took 3 years and billions in R&D investment, and palladium never went back to $200. Today it trades around $1,000, 5 times higher than pre-crisis levels. Silver is setting up for a similar squeeze, but with one critical difference. You can substitute platinum for palladium in a catalytic converter. You cannot substitute anything for silver in a solar panel without losing efficiency. You cannot substitute anything for silver in an EV without compromising reliability. You cannot substitute anything for silver in a data center without increasing resistance and heat generation. Silver's unique properties, its conductivity, its reflectivity, its antimicrobial characteristics, make it irreplaceable in most modern applications. And we're running out of it. Now I know what some of you are thinking. What about all the silver in COMEX warehouses? Doesn't that provide a buffer? Let's talk about COMEX, because this is where things get really interesting. As of last week, COMEX registered silver inventories. That's silver available for delivery against futures contracts, stood at 47 million ounces. That sounds like a lot, until you realize that open interest in silver futures represents 920 million ounces of silver. That's a ratio of 19.6 to 1. For every ounce of physical silver available for delivery, there are 19.6 paper claims on that silver. And that ratio has been growing. 5 years ago, it was 12 to 1. 10 years ago, it was 8 to 1. What happens when even a small percentage of those paper silver holders decide they want physical delivery? What happens when a solar panel manufacturer or an EV company decides they need to secure physical supply, and they're willing to stand for delivery on their futures contracts? We got a preview of this in March 2020. When COVID hit and industrial users panicked about supply chains, there was a brief surge in delivery demands on COMEX. Within 2 weeks, registered inventories dropped by 30%. Premiums on physical silver over spot prices spiked to 40%. The exchange had to quietly encourage some large holders to convert eligible inventory to registered status to avoid a default. That was a warning shot, and it was resolved quickly because COVID lockdowns temporarily reduced industrial demand. But what happens when we get a delivery squeeze during a period of surging demand? What happens when there's no temporary demand reduction to bail out the paper market? I'll tell you what happens. The paper price and the physical price decouple. We've already seen this in smaller markets. During the nickel squeeze of 2022, the London Metal Exchange had to cancel trades and shut down the market because the paper price bore no relationship to physical reality. Some traders lost billions. The integrity of the entire exchange was called into question. Silver is a much bigger market than nickel, but the same dynamics apply. When physical supply is insufficient to meet delivery demands, something has to give. Either the paper market breaks, or the price has to rise high enough to destroy demand. And given how inelastic silver demand is in most applications, we're talking about prices that would shock most people. Here's another angle that nobody's talking about: the strategic implications of silver supply. China currently controls about 60% of global solar panel production. They're also the world's largest silver consumer, using about 240 million ounces annually, and they've been stockpiling. Chinese silver imports have exceeded domestic consumption by an average of 40 million ounces per year for the past 5 years. That's 200 million ounces that went into China and didn't come back out. Where did it go? Some went into jewelry and silverware, but a significant portion went into strategic reserves. China learned from the rare earth crisis of 2010. They learned that controlling critical materials gives you geopolitical leverage, and they've identified silver as a critical material for the energy transition. If you control the silver supply, you control solar panel production. You control EV production. You control the pace of electrification in competing economies. Think about the implications. If tensions escalate between China and the West, and China decides to restrict silver exports or prioritize domestic use, what happens to solar panel production in Europe and North America? What happens to EV production? What happens to data center construction? This isn't hypothetical. China has already done this with rare earths, with gallium, with germanium. They've shown they're willing to use resource control as a geopolitical tool, and silver is next on that list. Now, let me address the elephant in the room. If this supply crisis is so obvious, why isn't silver at $100 already? Why are mainstream analysts still calling it an industrial metal with limited upside? Because the paper market is still functioning. Because most industrial users are still able to source supply at reasonable premiums. Because the COMEX hasn't defaulted. Yet. But the cracks are showing. Physical premiums are rising. Delivery delays are lengthening. Warehouse inventories are declining. And smart money is positioning for what comes next. Look at what the insiders are doing. First Majestic Silver, one of the largest primary silver producers, announced last month they're retaining 30% of their production instead of selling it. They're literally keeping the silver they mine in their own vaults. Why would a mining company do that unless they believed prices were going significantly higher? Wheaton Precious Metals, the largest silver streaming company, just raised $1.5 billion in a bond offering. What are they doing with that money? Buying silver streams from mines around the world. They're locking in future silver production at today's prices because they see what's coming. And then there's the ETF flows. The SLV, the largest silver ETF, has seen inflows of 42 million ounces in the past 6 months. That's physical silver being taken off the market and locked into a fund structure. The Sprott Physical Silver Trust, which is fully allocated and audited, has grown by 28 million ounces in the same period. Retail investors are buying silver at the fastest pace since 2020. The U.S. Mint sold 18.7 million silver eagles in the first half of this year, up 35% from last year. Premiums on retail silver products are running 25% to 35% over spot. That's not normal. That's a sign of physical tightness. But here's what really concerns me. The disconnect between the paper price and the physical market is growing. You can sell a silver futures contract on COMEX for $30.50, but try to buy 1,000 ounces of physical silver for immediate delivery, and you're paying $32.50 or more. That $2 spread is the market telling you that paper and physical are not the same thing. And that spread is widening. 6 months ago, it was $1.20. A year ago, it was 80 cents. The trend is clear. The paper market is losing its ability to suppress the physical price. When that spread gets wide enough, arbitrage breaks down. When it costs more to deliver physical silver against a futures contract than you can sell that contract for, the whole system stops working. And we're getting close to that point. Now, I want to talk about something that's relevant for a lot of you watching this. If you're sitting on retirement accounts, if you have significant savings in traditional assets, you need to understand how silver fits into a wealth preservation strategy. Quick aside here, if you have $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, what the rules are, what the costs look like. It's completely free. Link is in the description. Worth checking out if you're thinking about diversifying your retirement holdings into hard assets. Anyway, back to where silver prices are headed and why this matters for your portfolio. The thing about silver is that it's both an industrial metal and a monetary metal. It has a 5,000-year history as money. It's mentioned in the Bible, in ancient Egyptian texts, in Chinese historical records. For most of human history, silver was money. That changed in 1873 when the U.S. demonetized silver. It changed again in 1965 when the U.S. stopped using silver in coins. And it changed once more in 1971 when Nixon closed the gold window and ended any link between currency and precious metals. For 50 years, we've lived in a purely fiat currency system, and for 50 years, silver has been treated primarily as an industrial commodity. But something is shifting. Central banks are buying silver again. Wealthy families are allocating to silver. Institutional investors are adding silver exposure. Why? Because the fiat currency experiment is showing cracks. U.S. national debt is $36 trillion and growing by $1 trillion every 100 days. The dollar's share of global reserves has fallen from 72% in 2000 to 58% today. BRICS nations are actively working on alternative payment systems. The petrodollar system is weakening as Saudi Arabia opens to yuan-denominated oil sales. When confidence in fiat currencies erodes, people return to hard assets. Gold and silver. And silver has a unique advantage. It's affordable. You can buy an ounce of silver for $30. You can't buy an ounce of gold for $30. For most people, silver is the accessible precious metal. If we see even a modest shift of investment flows into silver, the impact on price would be enormous. The entire above-ground investment silver market is worth maybe $25 billion. That's less than the market cap of Chipotle. It's a rounding error in global financial markets. If just 1% of global investment portfolios allocated to silver, we're talking about $1.5 trillion trying to enter a $25 billion market. The price would have to rise dramatically to clear that demand. We're talking triple digits, potentially 4 figures. And this isn't speculation. We've seen it before. In 1980, silver went from $6 to $50 in a matter of months. The Hunt brothers tried to corner the market, but the real driver was inflation fears and currency debasement concerns. People were fleeing dollars and buying hard assets. We're in a similar setup today, but with much tighter physical supply and much stronger industrial demand. If we get an investment rush into silver on top of the existing supply deficit, the price could move faster and further than it did in 1980. Let me give you some price targets based on different scenarios. These aren't predictions. They're frameworks for thinking about potential outcomes. Conservative scenario. Silver reverts to its historical 60-to-1 ratio with gold. Gold stays at $2,650. Silver goes to $44. That's a 47% gain from current levels. This happens through normal market forces over 12 to 18 months as the supply deficit becomes more widely recognized. Moderate scenario. Industrial demand continues growing at 8% annually. Investment demand picks up modestly, and the gold-silver ratio compresses to 40-to-1. Gold rises to $3,000 on continued central bank buying and inflation concerns. Silver goes to $75. That's a 150% gain. This happens over 2 to 3 years as the energy transition accelerates and physical tightness becomes acute. Aggressive scenario. We get a supply crisis event. A major mine closes unexpectedly. China restricts exports. COMEX faces delivery problems.
Investment demand surges. The gold-silver ratio compresses to 20 to 1, which is still above the historical norm. Gold is at $3,500. Silver goes to $175. That's a 483% gain. This could happen rapidly, within 6 to 12 months, if we get a catalyst that breaks the paper market. Extreme scenario. Full monetary crisis. Dollar loses reserve status. Hyperinflation fears. Flight to hard assets. Silver returns to its monetary role. The gold-silver ratio compresses to 15 to 1. Gold is at $5,000. Silver is at $333. That's a 1,010% gain. This is the tail risk scenario. Low probability but not zero, and it could unfold over 3 to 5 years if we see a true currency crisis. Now, which scenario plays out depends on a lot of factors. But here's what I know for certain. The supply deficit is real. The industrial demand growth is real. The declining mine production is real. The paper market leverage is real. These are facts, not speculation. And the risk-reward is asymmetric. If I'm wrong, and silver just muddles along at $30 for the next few years, you've lost opportunity cost. But if I'm right, and we're heading into a supply crisis, the upside is multiples of your investment. That's the kind of asymmetric bet that smart investors look for. Limited downside, massive upside. And it's backed by fundamental supply-demand dynamics, not just speculation or momentum. Let me tell you about one more thing that's happening right now that nobody's paying attention to. The silver recycling industry is struggling. You'd think with silver at $30, recycling would be booming. But it's not. The problem is that silver is used in such small quantities in most applications that it's not economically viable to recover it. Your smartphone has about 0.3 grams of silver in it. At $30 an ounce, that's 30 cents worth of silver. But it costs $5 in labor and chemicals to extract it. So it doesn't get recycled. It goes to a landfill. Same with solar panels. They contain about 20 grams of silver each. But solar panels last 25 to 30 years, and when they finally reach end of life, the cost of disassembling them and recovering the silver is higher than the value of the silver recovered. So most of it doesn't get recycled. This is completely different from gold. Gold is used in large enough quantities that recycling is always economical. About 30% of annual gold supply comes from recycling. For silver, it's only 15%. And that percentage is declining as more silver goes into applications where recovery is impractical. So we can't count on recycling to fill the supply gap. We're dependent on mine production, which is declining, and above-ground inventories, which are being depleted. This is the supply crisis they don't want you to know about. Because if everyone understood the math, if everyone realized we're 3 months away from running out of available silver, there would be a panic. Industrial users would be scrambling to secure supply. Investors would be rushing to buy physical. The paper market would collapse under delivery demands, and prices would go vertical. That's why this information is buried on page 47 of industry reports. That's why mainstream financial media isn't covering it. That's why your financial advisor probably hasn't mentioned it. Because the people who understand what's happening are quietly positioning themselves before the crowd figures it out. JP Morgan figured it out in 2011. That's why they spent 9 years accumulating physical silver. Chinese strategic reserves figured it out. That's why they've been importing more than they consume. Smart mining companies figured it out. That's why they're retaining production instead of selling. The question is, when will the broader market figure it out? When will industrial users realize they need to secure long-term supply contracts? When will investors recognize this as the asymmetric opportunity it is? When will the paper market break under the weight of delivery demands it can't meet? I don't know the exact timing. Nobody does. But I know the setup is in place. I know the fundamentals are screaming that something has to give. And I know that when it does, the move in silver prices is going to be historic. This is the silver supply number they don't want you to know. 220 million ounces of available supply. 3 months of global consumption. In a world that's electrifying everything, that's building solar farms and EV factories and data centers at an unprecedented pace, that's trying to transition away from fossil fuels using technologies that require silver. 3 months of supply. That's the number. That's the crisis. That's the opportunity. And now you know.